be live. Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart. Very pleased to be welcoming you back here for another Wednesday macro overview with the macro maven herself, Stephanie Pomboy. Stephanie, how are you?
I'm good. How are you, Adam?
I'm good. All right, a couple quick things for folks. One, you have been on the program for a little while. Life has been throwing you curveball after curveball, Steph. You're in a temporary location at the moment, having moved and then removed and moving again. Your lighting is a bit dark, and maybe that's because one of the curveballs that have been thrown at you. You've been in the witness protection program.
Yes, it feels that way.
But anyways, folks, huge thanks to Stephanie with all that's going on in her life and in her home lighting, that she would come and make herself available for this hour for us. So anyway, Steph, it's wonderful to see you again.
Well, thank you. Actually, I like to say pitch black is my best lighting, so this is pretty close.
Yeah. I think you got a lot of doubters on that one.
It's true.
But anyway, Steph, I got to tell you, I cannot tell you how many people have been emailing me, DMing me, putting comments on YouTube saying, when is Stephanie coming back? So hopefully, folks, this is delivering exactly what you've been waiting for. So Steph, lots to talk about. Certainly a lot's gone on since you were on the program last. Probably the biggest one, which I know you and your co-conspirator in crime, Grant Williams, are going to talk about this in depth at the conference, which is Saturday. So folks, Thoughtful Money Conference is just a couple days away, but is the action in gold. So, in your appearances on this channel, Steph, one of the things that you've been pretty steadfast on is, hey, I'm keeping my position in gold. And this year that has looked smarter and smarter. And in the past couple weeks, it's looked almost darn fantastical. So what are your thoughts now that gold and silver have run so far off to the races as they have over the past couple of weeks?
Yeah, the move in silver is really impressive. And, a lot of that supply-demand imbalance is really being exposed there. But I'll tell you, as someone who, as you know, has been talking about gold for a long time, waiting to see it really move, the speed with which it's doing so does give me a little agita, But I feel like in the long-term scheme of things, this is really still very much early innings. I referenced a chart that just looks at how high gold would have to go to fully back the monetary base, and that's $22,000. So that's just an arbitrary yardstick, but it just gives you a sense as to if we are going to go back to some form of hard money standard, if that's really where this whole thing is going, gold could go much, much higher. That being said, I am fully prepared. I'm trying to prepare myself emotionally, but certainly intellectually, for a pullback of some magnitude. But I do believe that we will see that occur alongside a general de-risking across all assets. So I think if there is a pullback, everything's probably going to get dragged down with it. And gold will be included, but then it will just set itself up for another, maybe less sharp trajectory higher, but a steady and continued rise. I mean, I think we are in the early innings of a long-term bull market. And another thing I like to look at is just to kind of calm myself about how quickly it's run. If you look at the relationship between gold and paper assets, which is something you and I have talked about as well, like gold relative to the S&P, we're still really nowhere in the scheme of things. We're nowhere close to where we were when the global financial crisis happened, or back, when gold peaked in the early 80s. So we have a long way to go. But again, I am prepared for a spanking somewhere along the way. I'm not clever enough to figure out when that's going to come and how severe it's going to be. And again, I think that it will include a spanking across all asset categories. So there's not very much that I feel like I can do to avoid any pain there.
All right, so number of questions on this, Steph. So on the day we're talking, Jamie Dimon was just interviewed and said, "Hey, I could actually see gold going to $5,000 or $10,000 an ounce."
Yeah.
Right. So obviously, precious metals folks are cheering that to finally have a major banker on their team. It's funny because Dimon, like most bankers, said like, "Oh, I don't really like gold that much," but this is one of the rare times in my life that it makes a little bit of sense to own it, right? Which is about as much of an endorsement as you're going to get about gold from one of these guys. But the fact that he just even put $10,000 out into the ether there is significant, right?
Yeah.
So I've been raising the cautionary flag to folks who are loving this rally. And just to be super clear, I am loving it as a precious metals owner myself. But nothing moves, in a straight line, especially as far as gold and silver have in the short time they have. And so just technically, I mean, forget about big market drawdowns, et cetera. Technically, I'm just mentally prepared for the possibility of a pullback. And I want to talk to you in a moment about, if you share those concerns, what, if anything, are you thinking about doing right now, given your holdings? But you said here that that chart that you have that shows that gold's ratio to the S&P is still very attractive compared to where it's been in the past. Yeah. I've seen those charts, especially those charts of the whole commodity complex. Like, it's still like ridiculously undervalued relative to stocks, given the historic ratio. And I'm curious, as you think that over time that gap will normalize, will it normalize more because gold will continue to rise, or will it normalize more because the S&P will start to fall? I'm sure there'll be some combination, but do you have a gut feel for which you expect to be the bigger driver?
It's a really tricky question. As you know, for a long, long time, I have felt this stock market is massively overvalued, that that risk assets in general, not just equities, but also corporate credit, et cetera, have hit real extremes. And I've been waiting for an unwind of that long risk position. And frankly, I thought we would have seen that when the Fed cut rates and the long end of the curve refused to follow the funds rate lower. I thought that would be the moment where people would say, okay, we're not going to get the interest rate relief we were anticipating, so it's time to de-risk, because higher rates are going to be a problem for a massively levered consumer and corporate sector and public sector. That hasn't happened. I still, my heart is still in that view. It feels a lot, especially with some of the credit events we've seen in the last week with the TriColor and First Brands, et cetera.
And we'll talk about those in a minute.
Yeah, but we're probably starting to see some of that. We're definitely seeing a bifurcation in the credit markets, where for a long time, junk was actually outperforming investment grade, because it was, you got a higher yield and people felt like they're going to get bailed out when the Fed cuts rates. So why wouldn't you just be long this and get more coupon? Now that's shifting, and you've seen investment grade yields basically just kind of move sideways, while junk yields have really spiked higher, especially triple C's, which is the weakest. So you're seeing a little bit more of discernment around corporate credit. So I do think that we are going to get a deflation of the credit bubble, and that will also have knock-on consequences for the stock market. But that being said, I guess I'm less concerned about which one does the heavy lifting, whether it's gold going up or the stock market going down. I just think in the broad sweep of things, clearly, gold and commodities in general will outperform paper for over a long time horizon. I'm not just talking about the next couple of weeks. These are massive long-term secular themes. I mean, it could be, actually the commodity peak was 1980, and then we had this whole shift, multi-decade shift to paper assets over hard assets. And I anticipate we'll see a reversal that will last multi-decades as well in the other direction. So I guess, I'm expecting commodities and gold especially to move higher. The stock market, I think, may very well correct and go lower. I have a broken record on that, and it hasn't happened. But I am confident that we will, as we've seen over the last year or longer, see hard assets outperforming paper, even if the stock market continues to go up. I think I lost Adam. He's logging back in. Bear with us, folks. I'm not the best MC here. But I think he's logging back in. And he got Wilhelmina's attention. Wilhelmina, do you want to come say hi to the people over here? Come here. Look, what are your thoughts on gold? And any correction in paper assets?
Shoot.
I hear you. I don't see you.
Oh,
though.
Do you hear me? Okay, good.
Yes.
Sorry, folks. I don't know why this stupid camera isn't working.
Oh, there you are.
Now I see me.
That's all right.
Hey, there we go. Okay,
Wilhelmina was going to be the guest MC. Well.
All right. Wow. Hey, sorry about that, folks. Yeah, I had an issue here, clearly a memory issue with my computer. I was taking a screenshot trying to pull up some data in here based on what Stephanie was saying, and I think it just fried my connection here.
Oh.
All right. So I'll get to that in just a moment. But to round out the discussion here on the precious metal stuff. So, personally, I have taken out some hedges to hedge against downside risk in my position. They've been zorched so far, but I feel good about that because it's the same way like you feel really glad that your house didn't actually burn down, even though you bought fire insurance, right?
Right.
And now every time I put a new hedge on, I'm starting from a much higher level in terms of the value of my holdings, right?
Yeah.
So I personally just like I said, I'm loving the ride. I just am not trusting that it's of course going to continue forever, and knowing the volatile nature of the precious metals in the best of days, I personally want to have some protection if we get the type of technical pullback that I think is quite possible. I am not selling my underlying positions at the time because, like you, I believe that over time they will highly likely go substantially higher. And I've ridden enough of these up and down that I know myself. If I didn't hedge, I could live with it. But I've ridden through a number of multi-year corrections where I thought to myself, geez, I just should have hedged and not taken 100% of this correction on the chin. So this is something that everybody has to determine for themselves, do their own math, what they feel they could be most comfortable with. I will, though, remind people of prospect theory, which is research that comes from the field of behavioral economics. This was done by, I think, Daniel Kahneman. I think this is really what put him on the map, the guy that wrote the book, Thinking Fast and Slow, where humans, so much of the decisions we make are driven by our emotions, even if we don't realize that. And we feel the joy of a gain, or let me put it this way, we feel the pain of a loss about twice as much as we experience the joy of a gain. So it is something to remind yourself when everything's going your way and you're getting that, endorphin boost of seeing a higher gold price every day. Just know that if that price starts going in the opposite direction, it's going to hurt about twice as much as it feels good to have gold price go up here. So anyway, Steph, I'm curious, what, if anything, are you doing here with your gold positions?
Well, I haven't done anything. I've thought about it a good bit. And what I decided I might do if I were going to try to hedge a position would be to go long. I think I just struggle with options, in general. I've only successfully traded options on currencies ever, timing the stock market or commodities or whatever. It's just been very challenging. So I looked into a short gold ETF, which I thought would give me some hedge exposure without, having to set a time horizon, which is the problem with options. You have to get direction and time right, and it's hard to get them both, especially with the timing, and you get that erosion very quickly. So there is a 3-for-1 gold short ETF. I forget what it's called. And it essentially, you have to have the 3-for-1 will basically give you a dollar for dollar hedge. These 3-for-1 things don't actually work.
Don't actually provide. Yeah, exactly.
So it'll give you a dollar for dollar hedge generally. So that's something I've thought about.
Yeah.
But again,
the dangers with those, sorry to interrupt, as I'm sure you know, is the longer you hold them, there's drift.
Yes.
There's additional drift. Yeah.
Yeah. So there aren't really any hedges to me that are super compelling. And I also believe that any technical sell-off in gold would be short. So it's really not something that I see persisting over months or years. I think it would be something, that would be fairly fleeting. So I'm not really, this is why I haven't done anything, is I'm not convinced that it's, something that will necessarily really accomplish very much for me. So, and I don't know, again, my long-term view on gold, if it's going to 10,000 or higher, is why am I piddling around trying to hedge a decline back to 3,700 or 36, whatever the number is, in that long-term scheme of things. So I get it, psychologically, if it goes back to 3,600 or 3,500, I'm going to be, feeling like my lunch is up here,
yeah.
but
but you'll be all right.
Yeah.
And to be clear, you're still considering if and how to hedge, but you aren't selling any of your underlying positions. Yeah. It sounds like.
No, I thought about it. I thought about kind of reducing some of my junior minor exposure, et cetera. But again, maybe I'm being too cute, but I look at these long-term charts of where the mining stocks are relative to gold, and then where gold is relative to paper assets, and where gold is relative to, the supply of money. And when you look at what's happening right now with our fiscal situation, where again, the Fed cut rates, the long end of the yield curve hasn't moved, and this paradigm where we are being forced to finance these massive deficits with T-bills persists. The objective here was to be able to get the long end down so that we don't have to have this banana republic style deficit financing program. No one wants to rely on 3-month T-bill issuance to finance their deficits. This is not really a very solid long-term game plan. And we don't have any options right now. So that seems to be the program for the foreseeable future. And for that reason, I guess I feel like, the situation is not improving at all. Quite the contrary. I think that the fuse on this end game has just accelerated. It's getting shorter and shorter in terms of the moment where people realize that there is really only one viable solution to financing our deficits right now. And it's not just here in the US, but for the UK, Germany, Japan, et cetera. And that is for their central banks to essentially absorb a lot of the debt issuance. But
right, which is super pro precious metals.
Yes, absolutely.
Yeah. Okay. All right, folks. So, Steph, we're going to get to talk about the credit markets in just a second. Folks, I'm going to throw a couple of links at you real quick. One is if you are, wrestling with the question of, hey, I'm sitting on some good, really it doesn't have to be gains in gold and gains in the miners. It could really be gains in anything. But of course, we're talking about the big gains in gold and the miners so far this year, and silver. If you are wrestling with, hey, I do feel a little bit nervous here. I do want to still maintain my exposure, but I do want to have some downside protection risk. If you don't have a lot of experience hedging, especially if you've never traded options or whatnot, but are thinking they may be able to play a role for you, Highly recommend that instead of just trying to figure it out on the fly, you talked with a professional financial advisor who is very skilled in hedging with these tools, and they can sit down with you, learn about your specific personal situation, and then give you good advice. If you don't have a good financial advisor who can do that for you, feel free to talk for free to one of the ones that Thoughtful Money endorses. These are the firms you see with me on this channel every week. The guys at New Harbor in particular are really practiced at this. So you could just go to thoughtfulmoney.com, fill out the short form there, have a free conversation. There's no commitments involved. They're just there to help you out. Secondly, I've been trying to do this, but I've realized I should probably be doing it more given the demand that's been rising for it, given how well the precious metals have been doing of late. If you don't own any precious metals, or you're a little late to the party, and you're really trying to figure out, okay, what are the different ways in which I can own it? Which one might be right for me? I just want to remind folks that we have a free primer that kind of walks you through all the different options in terms of how you can own precious metals and when each one sort of makes sense for you. So it's a totally free resource, thoughtfulmoney.com/gold. If you haven't read it yet, feel free to grab it. Also, if you've got people in your life like I do, who are coming out of the woodworks now and saying, hey, you used to talk about gold and I didn't really want to hear about it, but now tell me a little bit more about it. This is a great thing to send them. Last, I mentioned earlier, we've got the Thoughtful Money Fall Online Conference now coming up in just a couple of days. It is fantastic. The speakers are really unbelievable. It's a really important time, a very timely time for this conference, because, Steph, I got to say, there is so much uncertainty out there, which you and I talk about every time you're on here. But I've rarely seen a time where there are more smart people looking at the same data and coming to different conclusions. And so, I think this is a really great experience for folks to listen to the 15 or so different experts we're going to have there, and listen to all the individual arguments each one is making, and then determining for them which one feels most rational, relevant to their lives, and then making their decision based off of that. But it's a really important time for this type of debate, I think. So folks, anyways, if you haven't bought your ticket yet, go to thoughtfulmoney.com/conference. And I will tell you, if you like precious metals, and maybe even more importantly, if you don't, spoiler alert, there's going to be a fair amount of talk about gold at this conference, given what's going on. But you'll definitely get your gold fill from almost every direction in terms of how it can be analyzed. All right, sorry for all that, but I wanted to make sure folks had those resources. So, okay, Steph, the reason why my picture froze up there was because I was trying to take this screenshot. So here is high yield credit spreads. And folks, you can see here, they started rising, near the right end of this graph here. But you'll see there's a big jump in the latest data set. Is just that little smidge of blue that's fairly above where the graph was beforehand. So, Steph, I think this is what you were talking about, which is we are finally starting to see credit spreads come to life here, which is something we've been scratching our heads about for a long time, saying, when is the market going to start to care? Looks like the market might actually be starting to care a little bit here.
Yeah, I mean, last Friday, I think, was really interesting because you had that 100% China tariff threat, and the markets really de-risked in a big hurry, the stock market and the credit markets. And what I found interesting was this, within the credit markets, as I mentioned, you saw investment grade credits really didn't move at all. It was all junk and lower quality credits that really saw the yields blow out and spreads blow out. So there's now a little bit more of discernment around different types of credit. We're actually penalizing junk rated borrowers as being riskier. That hadn't been the case heretofore. So maybe it's the beginning of a little bit of a new risk assessment, which could lead ultimately to this repricing of risk that I've been anticipating for so long. But I think it's going to take more, obviously, than either that the China trade issues or the one-offs of First Brand and TriColor.
TriColor.
Clearly, we're going to need to come up with a more high-profile name. I will say I've been surprised.
Be careful. Be careful. You might get what you wish for.
Well, that's the thing. I was going to say, well, I've been surprised that we've seen a lot of Saks, having basically going bankrupt.
Mhm.
That seemed like a pretty big name that would have gotten people's attention. And then you've seen a parade of bankruptcies, in the restaurant industry. We had Hooters and Red Lobster and all these, just a long list of, fast casual restaurants that have gone under, and no one seems to care.
And I got to say, just to talk about Hooters, when sex no longer sells, I mean, what kind of world do you live in, right?
Exactly. I mean, when the scenery isn't sale anymore, it's a problem. I think they were changing the outfits, though, weren't they? The uniform.
I think they were making them a little more modest and family friendly, which
yeah, exactly. Well, I don't know how many people are taking their kids to Hooters, but whatever.
More than you think. I've actually I'll admit this, I've been into Hooters once. I was a junior investment banking analyst. We were taking a client around the country on a road show, and we were in the Mall of America, and he passed a Hooters and said, I really want to go in there. And Steph, not only were there families with their kids there, but you go into the men's room, not the ladies' room, the men's room, and there's a big baby changing table.
Oh, really?
Yeah.
Wow. Okay.
So it's family-friendly fare, at least in a good chunk of the country.
I am told, I've never been to one, that the chicken wings are really good.
Yeah.
It's like, you only read Playboy for the articles, and you only go to Hooters for the chicken wings.
Exactly. Yeah.
Oh, man. Anyway.
Sometimes I'll go to Hooters to read the Playboy articles, but yes.
Oh, God. But, my point being that we've seen a long list of companies that people were intimately familiar with, no pun intended, that have gone bankrupt, and it hadn't really raised any eyebrows. So it's interesting that we're starting to see a little bit more anxiety in the credit space now. But, we've seen little blips before, only to watch it smooth over. I keep coming back to this idea, though, that everything heretofore, like all of the Hooters and Saks and all of those companies, that occurred against a backdrop where everyone was salivating about forthcoming Fed rate hikes, and we're wagering that, okay, well, Saks is having trouble and Hooters went out of business, and it's just because those guys couldn't make it to the point where interest rates were going to come lower.
They couldn't survive to 25, right? Which was
exactly. And here we are in 25, and the Fed cuts, and there's still no relief. So I think, I think the market, maybe the current thinking is, well, they've only cut once. Next rate cut will be the one that delivers the real rate relief on the long end. So it may take a couple rate cuts that fail to bring other rates lower to persuade everyone that, no, we're in a new dynamic here where just lowering the Fed funds rate in no way ensures that borrowing costs are coming down anywhere else in the credit spectrum.
Yeah.
And when we get to that realization, I think there'll be a major rethinking about where you want to deploy capital.
Yeah. And I mean, that's going to spill over into the housing market as well, right? When everybody realizes that the mortgage rates aren't coming down, the ride to the rescue here. So, so much to talk about on this. So, all right. So first off, I think you used the term earlier. You were saying, the deflation of the credit bubble is something that you expect to happen at some point along this journey here, right? You're in good company. So for the conference, James Grant, godfather of interest rates, he's speaking there, and he does similarly believe that we are in the late stages of the credit cycle where not good things happen. Basically where, if I remember correctly, you said, it's where most of the borrowers and lenders get on their knees and say, please, Lord, save me from this, and I promise never to do that again. And he said, only to be remembered until the start of the next credit cycle.
Right, yeah.
Forgotten again. But you and I have talked about, we've talked about the weight of higher for longer yields, right? And a phrase that you have used that I have totally overused, stealing from you, is we don't really know how bad it's going to be, especially in this cycle where so much of the lending has been done in the private credit market, right? Which we have no transparency into, right? We're all just hoping these guys are making good loans, right? So we're not going to know how good or bad the loans are until bodies start floating to the surface.
Yeah.
And I immediately thought of you in that phrase when I saw the news about TriColor and First Brands. I'm like, all right, there are some bodies that just floated to the surface that nobody knew, were in trouble until, lo and behold, the corpse is floating there. How material is that for you? I mean, does that give you a sort of strong sense of validation that, like, yep, this trajectory that I've been anticipating is going on, and these bodies are now evidence of it, and I'm going to expect to see more going forward? Too early to tell? What are your thoughts?
Well, I'm fortunate that I have a retired client who was working in distressed credit at one of these big firms that shall remain nameless. And so I talked to him a lot about what's going on. They actually asked him to come back as a consultant to help them figure out what to do with the portfolio companies that they had that were, barely on life support. And whether they could possibly sell those companies off or what they could do. And he went in and looked at some of these, and he was just shocked, as bad as he expected things to be. He was like, these companies are basically never should have existed in the first place. But the problem is you have to have a demand for that capital to bring that body to the surface. Like, there has to be liquidation by the LPs where they say, we want our money back, that forces the hand of these private equity firms to actually go out and have to mark to market. They have to get a bid on these assets. And could we see something like that? I'm sure we will at some point. The question is, when do the investors get nervous enough that they say, you know what, that First Brands thing or the TriColor or whatever, that makes us suspicious that there's more of this. And we don't want to have, let's say we're Stanford Endowment or XYZ pension. We don't want to have 40% exposure to these alternative assets anymore. Maybe we need to reduce that. We're going to start by cutting our allotment to whatever fund. So I think it's going to, unfortunately, have to come from the investor side, where they're going to demand the money back. And that's going to be the thing that pulls the rug out from under these firms and forces them to actually, come to market and have to find a price that isn't in fantasy land. But, you've seen things, this is a separate area, but in the commercial real estate market, where you've had buildings, that were sitting around, and let's say they bought them for, $500 million, and then they trade at 75 million or less, and you're seeing that happen on a fairly regular basis. So I would expect something like that to take place with these portfolio companies that these private equity firms are sitting on. But the question is, who's going to pull the trigger? I was surprised, like Stanford, for example, rather than doing that, saying we need to get income, so we're going to take some money out of these illiquid assets, they actually went out in the public market and borrowed to make up for the shortfall in the income that they were expecting would be thrown off by these alternative investments. So that was, a year or a year and a half ago that they did that. So the question is, do they now say, look, we don't want to go back to that well again. We need to actually adjust our asset allocation here. So we'll see. And I don't have any insight into what's going on in terms of those decision-making by committee, meetings at all these endowments and the pension firms. Generally, that stuff takes place after the crisis has happened. It's a belated, the horse has left the barn, and then they try to shut the door. So I think it's going to come maybe elsewhere, but it wouldn't take much. We have, how many people started these firms? There's so many of these private equity and venture firms that are sitting on losing positions. So it's hard to tell. It's impossible to predict when that would happen, but I do absolutely expect we'll see what we're seeing in the commercial real estate market take place with all those companies as well.
I saw, folks forgive me if this is incorrect. I may be falsely remembering the comparison, but I saw a tweet on X, I think it was yesterday, I think saying there were more private equity firms than McDonald's in America.
That could very well be the case.
Yeah, I can't remember if it was McDonald's they were comparing to, but I think it might have been. But yeah, just to show that, like, oh my God, there's so many of these. Yeah. All right. So here's a question for you. There was the recent executive order that is trying to make alternative assets available to be purchased within retirement accounts, right? And so one might say, okay, that's really to help the crypto industry, right? And to let people start buying stable coins and other things the government wants to support inside their retirement accounts. Obviously, gold people are kind of cheering, hey, this might bring more capital into the gold market, right? But there's also private equity and private credit in there. Does the skeptic in you say that that might actually be more of a backdoor way for these troubled private lenders to start dumping their crap on the unsuspecting retail investor?
Well, we've already seen them come out with the ETFs to get into, we have to give the retail investor the opportunity to get exposure to these usually, alternative assets that are only geared to sophisticated institutional investors. So we're giving them this great opportunity to get in the space. That was a signal to me that they were trying to offload a lot of this stuff a while ago. As relates to the 401ks and being able to invest in that, I'm of two minds. I mean, the sort of libertarian in me says the government shouldn't be limiting how you can invest your retirement money. So you should be able to put your retirement money in anything that you feel like you want to put it in. And you should also be responsible for the consequences of whatever decision you end up making. That's the problem, is that they will promote, now you can buy crypto and you can buy private equity and this and that. And then when all that goes bad, the government will feel compelled to bail people out. That's the downside of it. But I do think, people should be able to invest their money wherever they want to. And I do agree with you that part of it is probably driven, like this stablecoin reserve fund, by a desire to basically find other ways to drive money into treasury bills to help us finance our deficits. So that's another aspect of it. So will it end badly? Absolutely. But these ideas always come up at sort of the top. It's not when private equity was just getting going. That wasn't interesting. It wasn't like, oh, we should let people invest in that. It's only now that it's already started to stink to high heaven that they've decided, well, now let's open the doors and let the regular folks get in on this.
Okay. So the spirit of my question, sounds like the skeptic in you is alive and well. Yeah. Hey, folks, real quick. So if you have like a 401k at work, I don't know if this is true for other types of retirement funds, but I do know for most 401ks, if you're getting that through an employer, chances are your employer has given you, just a handful of funds to be able to choose amongst, right? And hey, we all kind of get the logic of that, right? Which is that most people aren't super experienced investors, and you don't necessarily want, an employee who's near retirement saying, oh, this Dogecoin thing looks interesting, and putting, all their retirement in that, right? But we can have a libertarian debate about that. I can certainly argue both sides. But in most retirement accounts, in 401k accounts, there is something called a brokerage option, which if you call up the fund and say, hey, look, I'm making this decision eyes wide open. I want to manage a part of my 401k outside of those few funds you made available to me, and I'll sign away, the form that says if I lose money, it's on me. And you can actually manage. I know when I did it, I was able to exercise it for half of my 401k. Some might let you do more. I don't know. But that is an option that many people have available to them that they don't realize. So if you're frustrated by just those 4 or 5 funds that you've got available in your 401k, call and ask if the brokerage option is available, and then you can decide, whether it's right for you or not. Getting back to credit, Steph. So, you've raised some issues that we're seeing at this point in time. I guess the big question is just, what's the risk of it becoming a systemic issue, right? Where credit starts really not flowing because of counterparty risk or things like that, right? And one thing we have going on here that you and I have talked a fair amount about, but I just still hear nothing about it, is the fact that there are trillions of corporate debt maturing over the next 4 years. Trillions and trillions, many trillions. And if yields don't come down materially, that is a big re-rate for the debt service costs that these corporations are going to have to pay, right? So forget about whether we are going into recession or the economy slows organically or all stuff like that. You're just going to have a mathematical impact on corporate profits as the debt service cost for these companies goes up pretty materially. So I guess my question here is from a systemic side, how worried are you about the little wiggles and warnings we're seeing right now metastasizing into something more severe?
Well, very. My sense about the corporate credit bust, and I've really been focused on corporate credit just because of the massive leverage and the maturity wall that you referenced there. I think it's $1.5 trillion next year and another $1.5 trillion the year after that. I mean, it's pretty much $1 trillion or $2 trillion.
I think it gets to multiple trillion for like 27, 28, 29, 30. They're all multiple trillions. You add them up. I'm making this up in my head, but it's somewhere like 8 trillion-ish.
Yeah. No, it's an enormous sum. And as you noted, the interest expense is going to go up sharply. Interest expense for the S&P 500 companies has already doubled since the Fed first started raising rates in 2022. Now I think it's somewhere around 450 billion for the S&P 500, up from 200-ish. Could that go up to 600 billion? I mean, it obviously is just going to keep moving higher. And as you said, that will come out of profits. So you need profits to grow that much more to offset the rising interest expense. But I think in general, when you think about how credit busts generally happen, is you start with the weakest link in the chain, whether it's First Brands or TriColor or those type of companies, and they go bust. And initially the reaction is, well, it's just those 2 companies. Remember in 2007, when the asset-backed commercial paper market was coming unglued, and Ben Bernanke gave up and gave a speech and said, well, it's isolated and contained. It's just the asset-backed commercial paper market. It's never isolated and contained because risk appetite is atmospheric, so if you're lending and you have exposure to a First Brands and that goes bust, your inclination to extend credit to anybody, whether it's an investment grade credit or AAA, whatever, you generally have a lower appetite to lend. You also have a lower capacity to lend because you just lost money on the one company that actually did go bust. So basically, it constrains the capacity, the willingness and the ability of the system to continue to lend, and that bleeds out. So it starts out with the weakest link in the chain, then it'll go up to the CCC credits, then it'll go to junk, then it'll go to investment grade, and eventually, I believe, you'll continue to see this even in the treasury market. And I think we're seeing it already. You're seeing the emergence of sort of a treasury risk premium, evidenced by the fact that the Fed's cutting rates and the long end of the yield curve isn't coming lower, because there's that fiscal dominant situation that's basically preventing long rates from coming down here, just like they are in Japan, like they are in the UK, et cetera. So I think that that's how it always works. That's how it worked after the dot-com bubble bust. It worked during the global financial crisis. That's how it worked in 2015-16, which people don't recall, but there was a massive corporate credit bust around then that was sort of started by the energy bubble. Remember the energy bubble in 2013, 2014, and the lending to that sector. And then when it burst, it not only hit the energy related stocks, but it hit the entire corporate credit market, and spreads blew out, and yields went up for everyone, not just those who were, touched on the energy sector. So that's generally how it devolves. And it can do that very quickly. Like we saw in 2007, in the summer of 07, I was looking at these asset-backed commercial paper spreads going out. And by, early 2008, it had metastasized into corporate credit. And, by the summer of 08, we were in a full-blown crisis. So it was less than a year from when the fuse was lit on the tiny little corner of the market to where it was an entire meltdown that ultimately engulfed, as you know, the conventional financial sector, the banking sector was dragged down with it. So I don't think, contrary to popular perception, that the banking sector will be immune this time, because they do have exposure, albeit tangential, to this shadow bank system. They are connected to these private equity. They loan money to the firms. So they will get taken. They will be collateral damage in this. Maybe not as material as they were in 2007-8, because they don't have the mortgage exposure that they had to that. But they are linked to what's going on in these opaque alternative assets.
Okay. And, I think I feel comfortable speaking for Melody Wright here, housing analyst Melody Wright, who really is a mortgage specialist first and foremost. I think she would say the mortgage loans aren't really quite as good as assumed too. So I don't think she's saying they're as bad as they were with the subprime crisis, but I don't think she's saying that they're
what they are. Yeah.
All right. So we're getting into the theme of I have to write the titles for these live streams before we actually talk about stuff.
I didn't know we had a theme.
No, it's okay. So the theme really is about the potential of a coming shakeout, right? And then if one happens, how do you try to be a winner in it, or at least a survivor in it, and not a loser? So you've just painted a pretty big, two big stories we've talked about. One is just the risk of continued devaluation of the currency, and that's tied to the whole gold trade that we were talking about earlier. Then you just talked about the risks in the credit market here, largely from both higher for longer yields and perhaps poor underwriting that's gone on that we're just beginning to learn about here. Now, there's another big potential threat here. Some would say this is what's going to save us all, but some would say maybe not, which is AI, right? And increasing amount of time. There's not a day that goes by now that there isn't articles written about AI being in a bubble, and some big name coming out saying, "Hey, AI is in a bubble," like Sam Altman did, a couple of weeks ago. Today, it is a Wall Street survey where basically, the majority of Wall Street bankers and investors have said, "Yep, it's in a bubble." Now, in their eyes, I think they're saying, "Yeah, so were .com stocks, right? But doesn't mean I couldn't make a ton of money in them while the bubble was raging, right?" So in their mind, it's not necessarily a bad thing, right?
Didn't that same survey show that they're invested in it as well? I thought.
I just saw the headline before coming on here, but probably. And like I said, that is the mantra. And even some of the experts that I've interviewed recently who are, pretty bullish right now in the near term are saying, yeah, this thing is a bubble and it'll probably not end well. But if it's 1998, there's 2 more years of phenomenal gains to be made, right? Yeah. So I guess my question here, just to distill it down for you, Steph, is how concerned are you, in addition to those 2 other big sort of shakeout threats that we've talked about, that the AI story, the bloom may fall off that rose sooner than later, because people are realizing one of many things. Hey, it's going to take a lot longer for the value to be created than we thought, or hey, there's all sorts of shenanigans going on with circular financing that's making this look more like a Ponzi scheme, sort of like the vendor financing malarkey from the .com era. Or China comes out with the next version of DeepSeek, and which is apparently coming out soon, and people realize, whoa, maybe there's just a lot less profit in this space than we thought there was going to be. How concerned are you about this as a shoe to drop?
I mean, I guess to the extent that it has been one of the sectors driving the rise in the stock market, I worry about it from that.
One of? I mean,
right.
practically the only, right?
Right. I mean, I'm thinking the Mag 7, I don't know how many of those are actual explicit AI stocks, but a lot of the move has been driven, let's say, by this excitement about AI and the technology revolution. But I guess, I just think about the stock market maybe too much monolithically, and I'm thinking that for me, and I actually wrote, the last piece I wrote was called Achilles heel, and it was talking about how the stock market, which we like to view, or certainly the administration and Trump has said, this is a shining example of the strength and the primacy of the United States. Look at our stock market and how well it's doing, and that's emblematic of the strength of our nation economically, militarily, et cetera. That in fact, that's our greatest vulnerability, because it's at this point just a massive bubble with just air underneath. And so if and when that bursts, the destruction to our economy is going to be so massive, and it could ultimately be the thing that brings about the demise of the US dollar reserve currency status. And I mean, I sound like such a hysterical broken record on this, but given the extremes to which the stock market has climbed in valuation now, which is beyond anything we've ever seen before, even the .com bubble bust, a return to normal valuations would be absolutely devastating. We're talking about a 65% haircut to the stock market here. I mean, that's more, you'd wipe out more wealth than the US GDP. We're talking massive sums. So whether it's precipitated by a bursting of the AI bubble, or if it's precipitated by the corporate credit bust bleeding over into a risk off that generally just deflates the equity bubble broadly. Either way, I think that the stock market is essentially this kind of elephant in the room, and keeping it aloft is so crucial to the Fed, the administration, and from a global standpoint, from a national security standpoint. I mean, it's a big deal if the U.S. will burst. And you could get really conspiratorial and say, well, our global bad actors, enemies of the U.S., might actually like to see the U.S. stock market bubble burst, and might try to figure out ways that they could do that. Now, obviously, I've spent a lot of time, and this is one of my concerns about the cryptocurrency boom in general, is that we enter a world of cyber warfare, and China obviously being a huge participant in that. Having things that are dependent on the internet, whether it's crypto or just the stock market, this whole AI bubble and all of that, makes us very vulnerable to that kind of attack. So, leave it to me to come up with these dark doomsday scenarios, but you do have to think about that in the current environment. I mean, we're living in a world where we are so totally dependent on an internet connection. We're totally dependent on the stock market continuing to move higher and higher. And all of these things are actually very fragile. And we imagine that they're so durable and permanent. And, should we find out the other way, it could be really quite problematic, obviously, from the standpoint of what does the government do then? how can they support the markets? What do we do? What happens to the digital currencies? I don't know. I mean, I'm just rambling here, but these are big picture questions no
You
one
went.
talks about. And I sound like a cave woman for even suggesting that, maybe you should be concerned about your internet connection if you're putting all your retirement money in crypto.
You went bigger and darker than I expected, but it's certainly a valid point. I'm sure on the minds of many people watching here. And I will say, folks, just to give a tease. So at the conference, Lynn Alden will be speaking on Bitcoin, and one of the questions she will address is not so much, hey, if the internet goes dark, you can't get to your Bitcoin, because by definition you can't, right? But in the age of AI, with AI getting smarter at an exponential rate, what is the risk of it getting so smart it can crack the encryption of Bitcoin, right? So all of a sudden, wallets aren't safe. Money can be pulled out, without your permission, stuff like that. So, anyways, if that's something you want to hear a very smart individual on the Bitcoin space like Lynn Alden address, she's going to address that at the conference. All right, Steph. So just to try to wrap this up, I got one last topic I want to talk with you about before we wrap things up here. But in terms of some of these big risks that we've talked about here, now obviously, you're trying to you want to be on the side of the winners or the survivors, not the losers. If some of these things manifest, obviously you're right for your clients. You're trying to get them on the right side of the line. Are you making any changes to your allocations right now, or are you still pretty much, pretty heavy in gold? Sounds like you're not selling any of that stuff, as we talked about earlier. Yeah. I know that AI, let me ask you a quick thing about AI that'll tie into your answer here. So even if the AI bubble bursts, right? Meaning there's a lot of loss of stock market valuation from this. Mm-hmm. My personal belief is that we're still going to pursue it as a top national strategic priority. I mean, this is the nuclear arms race redone here. So we're still going to have that build out of the energy grid to support AI, because we need to beat all other countries, especially China, in that race. And so even if you're worried about the AI bubble bursting, there's still an argument to be made that energy stocks are going to have a good future ahead of them because of that build out. Do you feel similarly?
Absolutely. Yeah, I mean, that's the thing and we've talked about this before, I think that just blows my mind, is that you watch these AI stocks go asymptotic, and no one shows any love for energy required to power it. If you're really a believer that AI, and I think you're right, it's going to be like the internet. It's not going away. So maybe the bubble burst, but it's not like the internet went away, quite the contrary. And it'll be the same with AI. You'll return to some more reasonable valuations for these companies, but AI is definitely going to continue to be a thing, and increasingly so, a larger and larger thing. And so I 100% agree with you. And that's why, again, I come back to, I don't know, I'm not knowledgeable enough about AI specifically, and it seems like it's highly debatable as to whether the returns are as billed so far. I mean, it seems like so far it's been a lot of sound and fury signifying, not so much in some cases. But it will get there. It will eventually be able to deliver on that promise. But to do so, it's still going to require a tremendous amount of energy, as will all of the cryptocurrencies. Mining digital currencies also consumes an enormous amount of energy. So there are a couple of things that people are very optimistic about as we move into the next decade, that will require enormous amounts of energy that we're really, this administration has done drill baby drill and really tried to open up as much energy production across all types, forms of energy as possible. But you haven't really seen that oil is now below $60 a barrel, but at 58, we're not talking about $20 a barrel oil prices, and electricity prices have been high for consumers. You've seen real increases in retail electricity rates. So this is an area that's going to require a lot more investment, and somehow gets totally ignored in the conversation about AI. It's just not sexy. You know, talking about AI is fun. It's the hot new shiny toy. Talking about fossil fuels and electricity production and that kind of stuff. No one, you know, yawn. That's so not interesting. Tell me something new. So, but I think that's really going to be it. That's again why I like this hard asset versus paper trade, is in large part the hard assets are the things required to support the paper, you know, that everyone's so enthusiastic about right now, whether it's the Bitcoin or the AI,
right.
etc.
They're the key foundation for the digital part, right? You need the atoms to enjoy the bits. Yeah. Okay, so one last point on this just is we'll talk about this next time, but you know, oil is not necessarily used, and not often directly used for electricity production,
right?
But oil is so cheap right now on a relative basis, and it's still going to, as much as we are rebuilding our grids, and that's going to be a decade-long initiative. The world is going to continue to need more and more oil going forward from there, even if you're a fossil fuel fan or not. And right now, it's being priced like the world is weaning itself off of oil, which it isn't. So anyways, we can talk more about that later, but another interesting part of the hard asset energy side of the story. All right, if you don't mind going just a couple minutes over the hour, Steph, there's a topic I really selfishly want to ask your opinion about, but I think there's a lot of people that are interested in this as well. So, folks may have been following my journey that earlier this summer, I moved to Nevada. And I moved, and not Nevada, which I've called it my whole life because I'm
Nevada. Okay,
corrected. It's Nevada. Yeah, if you're from here. But largely moved here to move out of the highest income tax state, California, to one of the lowest. So Nevada has a 0% state income tax. So Steph, you were smarter than I, earlier than I. So you moved out of New York years ago to a 0% income tax state. How has it been? So I've actually really enjoyed the move to Nevada. It was really kind of immaterial how I liked it because I was just going for the tax savings, but I actually really like it here so far. But I haven't had the joy yet of not paying income tax. I can't wait for that to come next year. How has it been for you having done this? Is it one of the greatest decisions you ever made? Is it, hey, they get the tax from you other sorts of ways, so don't feel so smug? What's the reality?
Well, I was going to say, I never envisioned myself leaving New York City. I thought I was going to be in New York City for the rest of my life. I spent 30 years there. Everyone thought, she's a city girl. And I came down here just to rent for a winter season to see if I could stand living in Florida. And, 1 month into it, I was like, that's it. I'm getting my Florida driver's license. I'm not moving back to New York. I literally.
Palm trees and beaches in the heart of February,
Exactly. I mean, it was amazing. And you can be outside all day. It's wonderful. So I love that from the standpoint of the taxes, which was certainly, for me, it was a motivating factor, but it wasn't the determining factor. For me, it was really the quality of life in Manhattan had just gone down so badly. So yeah, the taxes were burdensome, but it was really about lifestyle more than anything else. Mm-hmm. But moving down here, so lifestyle improved. The taxes thing, I found that yes, not paying state income tax was great, but the property taxes for me, once I bought my house, then I was like, okay, I have property taxes and the insurance. So, between those two, I may as well have stayed in New York, except, here I get the great quality of life. I had a bigger, pad to live in. So it was kind of a wash.
Did you own in Manhattan or were you renting?
No, I was renting in Manhattan.
Okay. All right. So you swapped, although technically you were kind of paying the property tax and stuff through your rent, but
absolutely. Yeah. But, here between the insurance, the homeowner's insurance, or actually it's the hurricane insurance, it's really expensive, and the property taxes, it's a lot. So it ended up I probably still ended up ahead. But for me, it was, personally, it was more of a lifestyle.
It was more the lifestyle switch. Okay. Well, we'll see. And you do live in a nice part of Florida. Is the cost of living notably different?
Well, now it's gotten insane because all of the other assholes from New York moved down here. So now all the prices have gone up. It's getting nuts. So yeah, but it's still, it's definitely a much better place to live. And yes, it's become more expensive. Restaurants, all the New York restaurants are down here, and they charge the same prices they do here, and in Beverly Hills and everywhere else. So it's expensive, but it's still a better place to live than Manhattan for sure.
Right. Even if it's even, you're getting a much better quality of life for what you're looking for.
Well, also, there's the prospect of my taxes going up doesn't exist here. The prospect of my taxes going up in New York is not a prospect; it's a guarantee.
It's a guarantee, yeah. And of course, especially now, looking at running for mayor, what may happen there, and then looking in Florida, you're complaining about your property tax, but there is a chance, I don't know how big of one, but there's a chance that could go away, right? I mean, Florida is contemplating, they're trying to work to get rid of property taxes.
I mean, that's the thing, is that the likelihood, the direction of taxes here will probably go lower, whereas the direction of taxes in New York is clearly going to go higher, and the quality of life there is going to go down at the same time. So yeah, I feel good about the decision to move down here for sure. I'd never look back with regret.
Okay, well that's good to hear. And folks, folks have asked me if I'd do a video about my move and the considerations and why I did it, and then also just sort of the mechanics of what I had to do, because they're at least leaving a state like California that really doesn't want to let you go as a taxpayer. There's a whole bunch of ties that you have to sever to be able to not continue to be taxed by California. So folks have asked me to do that. I am going to do it. I also will, folks, report back, April-ish next year, of just saying, hey, did this all work out the way that I thought it would from an economic standpoint? I will say, so far, cost of living is notably lower here, which is great. The place I'm renting a place right now only because we wanted to make sure the move was a good one, and I don't know Nevada all that well, and so I want to look around and really figure out where we want to buy. We are going to buy. That's the plan. So I'll let you know, Steph, about how I feel about insurance and property taxes and all that stuff when we pull that trigger. But I will say that we're paying a lower rent than I was paying in California, and we're getting a lot more for it. So no huge surprise there. And it is funny because, to your point, like at least the area I live in, which is a kind of nice part of Reno, 5 out of every 6 people I bump into is a Californian who made the move before I did. Yeah, so there is that migration going on that you're talking about. But it is interesting is just driving around here. It's quite pleasant, quite convenient, very easy, I'll say. And I was telling my wife the other day, we were driving to the airport. We kind of live outside of the city, so we're kind of up in I don't want to call it the country, but there's a lot of hiking trails and stuff like that. We're right at the foot of the foothills of the Sierras. And so we can see the city from where we are. We get a nice sort of cityscape out in the distance, that we're not in the city. But to go catch a flight, go to the airport, less than 20 minutes.
That's great.
It's just so easy and convenient. As I'm driving there, looking around, I'm saying, California kept telling us that we had to pay, the highest income tax in the country because they had to offer all these services to us. I'm like, a lot of those services aren't really best in class services, and they're clearly not doing as well as they used to do. And I'm here in a state that charges you 0, and all these services are pretty good. Roads are good. Everything else seems just fine, right? So there's definitely, I think in a lot of ways, a lot of waste, fraud, and abuse. No big surprise in these state budgets. And to see a state, I'm sure Nevada has its own issues, and I'm sure I'll complain about them when I collide with them. But so far, again, I'm just asking myself, why did I not do this years and years ago?
That's what I asked myself when I came down here. It's like, geez. But I think, in part, COVID really gave everyone a license to move to places that weren't necessarily financial centers. In the financial business, when I got going, if you weren't in New York or LA, you were pretty much a nobody. You had to be in one of the big cities You didn't start a financial services firm in Vail, Colorado. You didn't do it. But after COVID, now no one really cares where you are. It makes no difference. So it gave everyone more of a license to move around. So anyway, that's how I assuage my guilt at not having moved out of New York many years ago. But better late than never.
Better late than never. Yeah. And so, folks, if you're thinking about moving, at least you got 2 people here that took the jump and so far at least are quite happy about it. All right. Well, look, last and most important question for you, Steph. If folks want to follow you and the excellent publication that you put out, whether they are an institutional investor, you've got one for them, or whether they're a regular retail investor, you've got one for them, where should they go?
They can go to macromavens, plural.com. That's probably the best place to find out about what I do and subscribe. And alternatively, occasionally I get into a Twitter rage and I'll rage tweet at S Pomboy, and of course here on this channel with you. So
all right. Well, and thank you again for coming back. I know you've had a lot of things going on in your life, and I really appreciate in the middle of it all that you making the time to come back and talk to this audience.
It's good to be back.
Well, thank you. It's great to have you back. And folks, for sure, I've seen a lot of good wishes to you on this return in the live chat there. But folks, please express your gratitude to Steph. And then lastly, Steph is participating in the Thoughtful Money Conference, which again is this Saturday. She'll actually be in conversation at the conference with Grant Williams, her good friend and colleague. And so you're going to get to see the Grant Steph magic in real time there. We also have, just real quick to dial through the faculty from memory, we've got Lacey Hunt, we've got Judy Shelton, we've got Jim Grant, we've got Stephanie and Grant Williams, we've got Michael Howell, we've got Darius Dale, we've got Lynn Alden, we've got Danielle DiMartino Booth, we've got Andy Schechtman talking about precious metals, Melody Wright talking about the housing market, we've got Craig Wishner talking about investing in farmland. Then, of course, we've got all the thoughtful money advisors there who will be answering your questions throughout the day. It is really just an action-packed, phenomenal audience, faculty. And I think there's also a bonus video everybody who registers will get with Jeff Clark with his latest precious metals mining stock picks. So, folks, could not be more timely. Could not be a better faculty. If you haven't bought your ticket yet, run, don't walk to thoughtfulmoney.com/conference and get it. Stephanie, such a pleasure. You look great. Good luck on the move back into your final place for the year here. I know you got one more move ahead of you here, but hopefully it goes well. And in the interim, just only tons of love and appreciation from this side.
Thank you so much. I really appreciate it, Adam. And it's great to finally be back and get to see you.
All right. Well, thanks so much. And hopefully next time we'll get to see Wilhelmina.
Oh, well, she filled in when you were out for a minute. So.
Oh, good. Yeah, you know what? I probably just opened the door to disaster there. I think people are going to say, hey, just make it the Wilhelmina Steph show.
Oh, my gosh. All right, sir. Be careful what you wish for, because that would definitely implode.
All right, Steph. Anyways, thanks so much again. So great to see you.
You too. Thank you.
All right, everybody else, thanks so much for watching.